On this episode, I get to spend some time with our underwriting manager, Jerry Tubbs. You might be familiar with his voice from our intro. He has underwritten thousands of loans in his career and has seen almost every scenario you can imagine. We discuss topics from catching mortgage fraud to how you can package a loan to almost guarantee an approval. Just kidding, but definitely his advice will give you the highest chance to get your loan approved. Listen close as we hear about the craziest loan Jerry has ever underwritten to finding creative ways to originate $1 million non-QM loans.
Welcome to the $1 Million Mortgage Experience Podcast. Listen in as CEO Jon Maddux of FundLoans reveals tips, secrets, and origination ideas to fill your pipeline with $1 million opportunities.
Welcome to the show, Jerry. Thanks for coming on.
My pleasure.
So all of our viewers, most of them are mortgage brokers. They're people that want to learn a little bit about non-QM. This is a chance for them to really lift up the curtain and look under the hood and just to kind of see what's behind a loan. Like when someone's looking at a non-QM file, and I think we talked about this before we started the cameras, is like for an underwriter, maybe it's like in my mind, it's like they get a present, like they get this present, they gotta unwrap it and see what's in there, because you never know what's going to be in that file. Like it could be a big $3 million loan, it could be a smaller loan, it could be something crazy. But I know as an originator how many different scenarios I've seen in 21 plus years. As an underwriter, you get to see every little detail about this person. So you get to look in there. It's like you see their dirty laundry. You see everything about them. Like, tell us just real quick about how you got your start in underwriting.
I actually started out in sales. I was originating loans, and kids started coming along, and I made a decision that I might want to, at the end of the night, rather than being in a real estate office at 8:30 at night, I might want to be home playing with my kid. So
it's a good life choice.
I took an opportunity to stay involved in the mortgage business doing that way. I had a really good track record as an originator, getting loans done. Went 3 years without a denial. So I was doing a lot of underwriting at the application.
You were actually your own underwriter.
I was. So it was a natural transition for me. One of the things that really benefited me and kind of skyrocketed my career was being able to take that ability to structure loans like an originator and not forget how to do that when I got into underwriting.
Interesting.
So being able to leverage loan structure as an underwriter and figure out how to make things work versus how to make them not work is kind of helped me make my mark in the underwriting world. So pretty soon I'm being asked to manage underwriters and contribute in bigger ways because of that ability.
That's very cool. So in your office, you have on your wall, it says mind-bending mortgage lending. What does that mean to you?
For me, it's a reminder that, again, I'm trying to figure out how to make the business work for customers, not how to remind them how it doesn't work. And in the
coming from a place of yes, sort of.
Yeah, the really cool thing that makes it fun for me to come over to work every day is I'm not doing commoditized loans. I'm not doing Fannie Freddie and just reminding people how they don't fit into this cookie cutter that those agencies have created.
Right.
I'm in a space where when people, when it makes sense that people have the money and the wherewithal and the desire to be homeowners or change their financial situation, that we've got products that accommodate them, even if they don't fit into this cookie cutter that the agencies have created. So that's fun for me. And
because you get to use a little more creativity in the process, and it's not just like anyone can do it. It's kind of like, I think I almost look at it from a songwriter standpoint or from a musician standpoint. There's the people out there that can read music, and then there's the people that can either play by ear or they can play by just kind of making it up. They can just sit down at a piano and just kind of make up something, but it sounds good, right? Or they can go pick up a book and read exactly, Bach or whatever the piece is, and they learn how to do it. So, but often people who can read music have a tough time playing by ear or just making stuff up
or coming up with something new,
and
like
so
you're
there's
saying.
Some creativity, I think that fits in certain people. It sounds like you're not just the kind of person that can just read music or read like make sure something fits in the box, but you can say, well, maybe this makes sense if I do these two different things, or look at it from a different perspective. Is that?
Yeah. I would say in music, I'm a remedial reader. I can read it eventually, but not very fast. But when I can play the radio that's in my head, you lock me in a room, and 30 minutes later, if you need a jingle, you're going to have it.
That's cool.
And I feel the same way about underwriting. There's going to be this mishmash of assets and income and property and credit. And you look at it, and once you evaluate it, you have an opportunity to say, I can make something out of this.
That's cool.
Whether this would fit in this product, or I can't do it there, but I could do it there, or if I, tweak this or paid that off, and keep molding it until, or, almost like turning a Rubik's Cube until those colors start to line up and you can cross the finish line with a solution.
That's a cool way to look at it. Yeah. So I don't really like the word non-QM just because it's like, what does that even mean? Right. So, but I know we call it make sense lending or alt doc or, non-prime, but it's not really not even non-prime, because a lot of these loans are, good FICOs, good credit, maybe one little thing's off here or there because they're human, right? And they don't always pay attention to their credit. Some people are paying attention to their business, they're self-employed, and they just, either the person they've hired to take care of their credit, or it's just something missed or something got missed. And so the credit score is not always perfect, but, what about this is what we call make sense lending? What do you see is kind of the reason why non-QM is make sense lending?
Well, I think one of the things is sometimes you'll find a disparity between someone's FICO score and their credit performance. And and it was something I struggled with when FICOs were first introduced back in the 90s. They were really introduced to create some electronic convenience for what was a newfangled toy in the mortgage business back then, which was LP and DU. It was a lot easier to program one box to plug a FICO score in than to actually create a computer that would look at a credit report and decide whether someone was creditworthy. And one of the first things we ran into then that I still run into today is some people have different attitudes towards using credit. And especially with some of the wealth profiles that we see, we have people that have so much money at their disposal, they would never have to use credit. They would never have to borrow money unless it was a convenience for them. There's certainly never a necessity to borrow money. And those people traditionally that don't use a lot of credit are going to have a lower than normal credit score. And it has nothing to do with their ability to repay. You can look at a sheet full of accounts that they had years ago that they paid on time. So you'll get people with lower credit scores, and by that I mean someone in the 600s instead of the 700s, let's say. And they've got 10 or 20 trade lines that they haven't used in years. And every single creditor they've ever had contact with has been paid on time, but they're pulling a 640. And someone with 2 or 3 trade lines they've used recently might be in the 700s. And I would rather lend money to this person that doesn't need the credit, frankly.
And that's what you see, like sometimes in banks, like it's like, if you don't need the money, that's when it's the easiest to get it, right? You've got all this money in the bank, and you got, like no real need, but when you're like, gosh, I need to borrow another few grand for whatever, they're like, nope, sorry, no. So without divulging private information, you've been in this business a long time. I know you've probably got at least one interesting story that you could share about like a crazy underwriter, crazy borrower, crazy profile, whatever it might be. Just something interesting. What would you say?
The one that comes to mind almost immediately, and to your point, there's hundreds. It's like making me pick my favorite child. One that comes to mind that was one of the trickiest ones. I was working for a big bank in New York, and a very well-known former baseball player came in. And
like walked in?
Actually physically walked into the bank, to the branch. And when he explained the situation, they're like, we can't help you. We need you to talk to this guy. So got ushered up to my office. Anyway, when he left baseball, he was on these extended contracts that continued to pay him years after he played. So he was still at the tail end of these multi-million-dollar contracts, dropping money in his lap, and hadn't picked up a bat or a glove in 5 years. Anyway, post baseball, he had got successfully involved with some real estate developers, and they began buying up high-rise apartment buildings that were in disrepair. Mm-hmm. And they would form an LLC for each building, each individual address. They would take the building from a bombed-out hole. They would completely rehab it. They would fill it with Section 8 subsidized rentals. Mm-hmm. And then when this investment was upright, it was full of paying tenants, they would present that as a turnkey rental opportunity for an investor that didn't want to get their hands dirty with the rehab process and the rental process. And the numbers were astounding. Each building could be acquired for 10, rehab for 5, held for another 5, and sold for 30.
Wow.
In the month, the reason I came to Pass to even talk to this gentleman is he was looking for a mortgage for his own home.
Gotcha.
He was moving his family away from the city and out where he had grown up, buying a beautiful home, going through the traditional mortgage process, and confronted with the type of things that the traditional mortgage process slaps in your face, which is, I need 2 years of tax returns on all your businesses.
Right.
At that time, the moment that I met him, he had 60 of these buildings in the pipeline.
Wow.
About 10 to 15 that were in the acquisition phase.
Were these each LLCs or corporations?
Every single building was a single LLC.
Wow.
He had 60 LLCs.
So it's a light dock deal.
It was presented as a full doc, double year, because that's the only type of things that big nasty bank did.
Yep.
And he was.
And this is probably back in the day when you had like physical files on your desk. Yeah.
It was digital. This is only a few years ago, but the idea of a single underwriter tearing through all 60 for both years, coming up with cash flows for a situation where every building was on some different level of spectrum of completion to just bought the building yesterday.
Yeah.
Got it rehab but not rented, fully rented and on the market, or sold. Mm-hmm. But this process of grinding these buildings through this process, so they get so good at it, it was like printing money. In the 2 or 3 times that I met to get some documents, ask some questions, clarify, this gentleman brought in multi-million-dollar settlement checks from buildings that had successfully closed, and he's just depositing them in the checking.
He's like, here's another one.
Absolutely. But anyway, the solution for us was to leverage the portfolio power and isolate, balance off the LLC's cash flow. So we actually ended up cash flowing all these buildings, but did it at a K1 level, added back the millions of dollars of depreciation on all these buildings to show that this man didn't lose $10 million last year.
Like it says on his returns.
Yeah,
But
he actually made $30 million and didn't pay taxes on any of it. So
it sounds like a good model.
Presenting it the right way, understanding those cash flows, knowing what we could add back, where the paper losses were, knowing what we could do with those loans, we were able to prove that he was an extraordinarily wealthy person, a very good risk for the loan, and we were able to get him closed on his new purchase on time. And last time I spoke with him, he was wildly happy and still very grateful.
That's cool. Were you a fan too?
Had never met the person or had followed his career.
Yeah.
But at the tail end, got him to actually autograph a couple baseballs for the guys on our exception desk.
Nice.
That said, thanks for getting me home.
Oh, that's cool. That's great. So, these kind of deals are obviously different, and there's makes sense approach to them. But like, how does it differ? What's some of the main differential or different points that you could say between agency, government, and non-QM? Like, what were some standout things that really kind of differentiate it?
I think one of the missions for non-QM has turned out to be making it easier for self-employed to get money that they deserve.
Right.
Typically, if you're starting a new business, even one that gets traction immediately, you've got to sit out 2.5 to 3 years to have enough of a paper trail with the IRS to be able to walk into a traditional lender and say, I can prove to you I make enough money to afford this house payment.
Right.
And using products that have flexibility like bank statement loans gives me the opportunity to catch those people once they're already successful, but not make them sit through the 2 or 3 years it's going to take to develop an IRS-worthy paper trail.
Yeah.
So we can get people that have an immediate need for the money. They have a great ability to repay. They're not a big mortgage risk. They just don't have the paperwork they need to satisfy those big bad agencies.
Right. And I mean, you said so just right with like self-employed borrowers. I mean, that's something that's trending up, especially like, more recent. There's a lot of people that are just starting new businesses, people that are going from being a W-2, say, like they're going from a W-2 job to being a contract employee. So like they get let go, or they say, well, we still want you, but we're going to pay you 1099. Or they've been doing, like say they've been a doctor at, Scripps for many years, and then now they're a doctor, but they're in their own practice, so it's like, you really are going to say this guy's, risk is much different. I mean, I know it, going out on your own versus having people walk through your door from a big hospital is different, but they're still similar profession, things like that. They've been doing it for a long time. It's always interesting to see how the guidelines of Fannie, Freddie, and government just, it really doesn't take into consideration the make sense approach.
They're biased towards wage earners. And when you think about it, self-employed people are still the exception and not the rule.
Right.
So, I would bet it's an 80-20 type situation where, 80% of us, 90% of us are wage earners. It's that special 20 to 10% of folks that are out there doing their own thing. The rules aren't really written for them. And so those exception type borrowers need exception type mentality. You have to think about those people aren't going to be living their life just so they can come in and make it easy to do a mortgage once every 7 years when they need one.
Right.
They're living their life the way they need to. They're managing their cash flow for what makes sense for their business and their business strategy. It's my job, I feel, to take a look at that, stand back for a moment and go, you make more money than I do. You deserve a loan.
Right.
How do I tell your story in a way that that takes advantage of what you've done that is exceptional, and present it in a way that makes people realize there's not a lot of risk in this borrower compared to the one that has 2 W-2s and a pay stub and
because they could get fired tomorrow and lose their job.
Yeah. And then they'll be self-employed anyway, looking for work.
For sure. Well, on that kind of thought, what can brokers do to better, how can they do a better job at getting the loan prepared to be seen by an underwriter like you?
I honestly think you need to be a better storyteller. And I would take the time to type up a paragraph of, what does this guy do? How does he make his money? How much money does he typically make? How often does he make it? It's so many times I can't tell you where you'll have a very generic sounding business name that really doesn't tell you if this is a product, if it's a service, or if it's any other kind of operation. And those type of details help make sense. Because then when I look at bank statements, it makes the deposits that are going in make sense. Like, oh, that's probably one of his business deposits because it's the right size, it's the right frequency. So telling the story, understanding, and I got to believe, if you're an originator, I got to believe that showing that much interest in your borrower to find out how he makes a living, it's got to be a great rapport builder.
Oh, yeah.
So there's a great reason to do it anyway.
Sure. You have a great chance. People like to talk about themselves too. So if you're asking like, tell me how you make money, and they want to just talk, and you can take notes.
I would assume you'd have trouble shutting them up.
Right. Yeah.
But you're going to learn things that are going to help you present the loan to someone like me and help me understand, because I'm going to have the same questions from a different perspective, which is, I need to know how this guy makes money.
Yeah, and you're looking at bank statements. So you're seeing all kinds of deposits, and some of these deposits, you're like, "Gosh, is this income? Is it not income? Is it just somebody's transferring money from here to there?" And so yeah, to understand that right off the bat would help you from going down some bad rabbit holes and thinking things that aren't necessarily true, right?
It reminds me of a situation I had. I had a borrower that was a Schedule C borrower, so I actually had tax returns in this, and it wasn't real obvious what he was doing. What was real obvious that he was making a lot of money, and the expense ratio was really almost unrealistically low, so low that it felt like, could these be fraudulent returns? I actually ended up calling the borrower just because I was curious, because it looked like it had something to do with precious metals. But it's not like he had a storefront where he's buying and selling precious metals. I couldn't quite make the connection. So finally, he just broke down and said, if I have permission, can I talk to your borrower and find out? So I called him up, got him on the phone. Turned out what he had discovered is that catalytic converters in cars have a small amount of recoverable platinum.
Really?
And he had a process that would recover that. So his day was spent going from auto junkyard to auto junkyard, buying as many used catalytic converters as they would sell him. He would recover the platinum, and he was so good at it. And platinum is, I don't know what it is per ounce, but back then it was
expensive. Yeah.
Back then it was $1,000 an ounce, and he was recovering, pounds of it every month from junkyard salvage.
I wonder if he's still doing it. I mean, there's probably only so many of those.
He's probably retired by now. He was making a lot of bread when I knew him.
Wow, that's a cool thing. So you went and called the borrower and found out that's kind of what was going on.
Tell me the story, and then it just made me jealous afterwards.
So I mean, that makes me think like this. I mean, and I know mortgage lending is not always exciting. Trust me, it's not the most exciting business, but there are times when you get to look and see some things and hear some scenarios that actually are exciting in a way, because this stuff is interesting. You actually could probably
I've been doing it for 30 years, and for me it was Shark Tank before there was a Shark Tank.
Oh, that's cool.
Because I would learn how especially self-employed, how they found a niche and exploited it with their knowledge or their first to market or whatever their advantage was. And I've had the benefit of seeing 1,000 different ways to make money, and it's all fascinating.
That's very cool to see. You mentioned fraud a minute ago. It's been a long time since I've heard about or seen fraud in the mortgage business, thank God. But before the crash, before 2008, there was some fraud happening. Like forgeries and different things, and using debt appraisers' licenses. I mean, I've heard of stories, but recently. We kind of came across something that could look like fraud. I know that, someone did something, but like, it seems like a loan officer would not risk their livelihood, their potential like freedom, to go to jail or anything like that. Like, I think loan officers are probably less likely to do fraud these days, and maybe it's borrowers. Like, what do you think? Like, do you think that's something that's kind of coming back? Do you think there's more fraud coming, or, with these type of loans? Or
that's a great question. One of the points you made was, I think most loan officers and most people in the mortgage business have that mindset that it kind of, once you're in the business, you kind of decide, well, I really like this. And I had that feeling very early. It's like, I like this. I'm good at it.
Yeah.
I'm going to do this. And as soon as you have that much skin in the game, you are very conscious of, I got to make sure that my behavior doesn't jeopardize this, because this is something I'd want to be able to do.
Right.
And I wouldn't want to do something that would prohibit me from being able to ever do it again.
Right.
So that mentality is always on my mind. Also, I think the longer you're in the business, your personal reputation means a lot. I mean, if you end up working with other companies that are, because you're selling them loans or appeasing to their quality process, and if they don't trust you, it impedes your ability to do, business with that. So I'm a big fan of, once you've decided this is a business for you and you want to stay in it, it's pretty easy to stay on the right side of what to do. In terms of the fraud question, I've been doing this long enough to where I see an evolution in fraud. And believe it or not, in the 90s, when I'm managing large underwriting groups in where we were at the time, credit report fraud was our biggest problem.
Really?
There was 1,000 mom and pop credit bureaus. And it would be very easy if some account that was jeopardizing your loan approval showed up on a collection account, let's say.
Sure.
It would be real easy to call mom and pop credit bureau and say, I'm not ordering another credit report from you again if you don't get that off of the guy's report, because that's keeping us from closing. So there was some undue pressure you could apply. One of the things that solved that was when DU and LP came out and people were ordering credit on their own, untouched by an unscrupulous player.
Once removed, yeah.
Yeah. Then you knew this is the real credit data, blemishes and all, and what are we going to do with it? And with it came kind of some doc relief where at that point, then the agencies, knowing they were getting good data, could then start to create relief. Or, if it's this balance, you don't have to pay it off, or it's this old, you don't care.
Right.
So they actually, it solved the problem. The next biggest thing we had was tax return fraud, and once the cooperation was set up with the IRS to get transcripts, it really took a lot of the tax return fraud away. And companies that do a good job of making sure they transcript that information protect themselves from a lot of exposure. So you got two big chunks that have been taken out of the industry in my lifetime.
And also appraisal fraud is probably way low now because there's just... You have to have an AMC. You can't, just order an appraisal from the appraiser. I can't just, hey, I need a 2.2 value. Can you do that? Nope. Okay, next guy.
Yeah.
That's how.
There was a lot of pressure. And it sounded very much like the credit report pressure, where I'm never ordering an appraisal from you again if it doesn't come in at this.
Right.
So now that pressure is gone, I do think appraisal values are a little more solid, and computerized tools help as well. AVMs have come along so far that
you can pull up Zillow and Redfin and go, that says it's worth only, $1.3 million, but you're saying it's worth $3 million. Let's see. And then there's no comps. You can really.
You can start to triangulate.
Really quick,
Yeah, you can start to triangulate what your appraiser is saying and what your realtor is saying and what data is saying, and start to. Yeah, it's probably somewhere in here. And and the only thing that we haven't really done in the appraisal world that we need to do is. We need to give appraisers the ability to create a value range rather than a value. Because on any given day, depending on how desperate of a buyer you are or how desperate a seller, that $1 million property might go for $980 and it might go for $1,020,000.
That would be an interesting concept to do a range instead. Yeah.
Yeah, because then you could, as a lender, you could decide, hey, this is the upper part of the range, but it's still within reason.
Yeah.
Maybe I'll do it at 90 instead of 95. You could play with that range and get comfortable.
Change the pricing a little bit too.
Yeah.
Going into the red, you get into the red zone. You're adding a little bit to the rate.
Yeah, exactly. Make me interested again. So the last bastion for me is bank statements, and unfortunately, it's one of the few pieces of information that we still ask borrowers to provide because we don't have easy, direct access to get the information ourselves. And and with the tools that are out there, it'd be pretty easy to turn that $1,000 deposit into a $10,000 deposit and make it
zero.
Look. And I think the reason we're possibly even talking about it recently after this evolution of all the other things we've chased out of the business is bank statement loans are now a popular way to get financing, and it's an easy platform to, if you're not getting the answer you want with your bank statements, a little Photoshop might change that answer. So it's something that I'm sure the industry is going to have to address, and frankly, there's a lot more technology out there too that could possibly address it than there's ever been. So I see that window closing because bank statement loans are getting so popular, and people aren't going to stand to get ripped off, using borrower provided information that's not quite on the up and up. So.
Makes sense. So we've kind of talked about some of the things you like about borrowers, and and just being able to see kind of interesting stories and hear interesting scenarios. But what would you say is your least favorite borrower, or type of borrower even? Would it be like crazy income tax stuff, or would it be just maybe someone who's just spending too much money? Like, do you ever get like, like kind of not judgmental, but at the end of the day, like, oh, this guy doesn't deserve credit. This girl doesn't deserve credit because of whatever. Like, do you ever get personal in there? Like, I mean, I know I'm putting you on the spot, but
I don't really have. I can't say that I have a prejudice on how people make their money or how they spend it. And most borrowers are pretty, it's amazing how self-disciplined they are. It always has amazed me but even before I figure out what someone makes or doesn't make, they're pretty good about coming up with a monthly housing payment number that's comfortable for them. Mm-hmm. And sometimes the challenge for me is figuring out, why do you think that's a good payment for you? Yeah. But then when I get all the facts in, it's like, oh, big chunk of your income's tax free, so it feels like you make more. Or that's you have this debt, but you're not having to pay it; someone else is paying it. Or so there's different things at play where sometimes I don't get it initially, and then the longer I work with a borrower, it's like, oh, I get it now. In terms of I would say the only frustration I ever have with borrowers, and it's fairly rare, is occasionally you'll find a borrower that you've kind of created a roadmap on how to get them from where they are to the closing table. Mm-hmm. But you need this, and that. Right. And they've decided, either from their personal frustration or lack of understanding about the business, that I'm not giving you that. Yeah. And so every once in a while, it's like, you try to be patient with people, and I realize it can be frustrating for some borrowers because they don't go through the process very often. They don't understand it. But I would say if there's a borrower that ticks me off, it's the one that tells me what the documentation level is going to be, rather than the other way around. But what are you going to do? You got enough stuff. Just tell me yes or no. Yeah, exactly. It's like, I don't think so. I think it's a little bit of the golden rule there. So. Yeah, and they always also... but I gave you everything. You said that was it, and now you want more. And it's like, well, it's like conditions beget conditions. It's like sometimes it raises another question that you didn't think to ask because that's the answer. But that doesn't happen very frequently. But every once in a while, you get someone that's just had enough, and unfortunately, they're giving up a few yards from the finish line. It's like we gotta get one more furlong down the track. So, do you think these loans are risky? Well, no. The type of loans that we're doing typically have really sexy LTVs. Yeah, they do. And skin in the game. Yeah, when you have a borrower making that kind of investment, either protecting an investment equity they've already earned in a refi, or hard-earned money going down for a down payment, that's a big deal. That kind of skin in the game really helps predict what their behavior will be if they ever run into trouble, some life event that keeps them from being able to make the house payment. Right. The hope is, as a lender, that you'll make the decision of whether or not you could truly afford the home anymore. It's this is temporary setback, or it's like, my income's going to be reduced for a while. This is not the right house for me. Right. And the hope is that you'll take the right kind of action and put the house on the market, grab the equity that you have, and make a better life decision based on your new circumstances. Sure. Versus dropping the keys in the mail or not making your payments or those sort of things. So doing the larger down payment loans, you can see a lot of people that, their intent is to make those payments, preserve their credit, and enjoy that equity. Mm-hmm. And I love working with people, that kind of motivation all day. Yeah, that's true. I was thinking about, I've been seeing lately people talk about there's another crash coming. There's, a big downturn. It's due. It's inevitable, and I always think about it like, I like to look ahead and try to look around the bend, but it's never easy to, you don't have a crystal ball. But, knowing what we know about how tight mortgage lending has been, and how, all these laws are in place to protect us from getting, crazy appraisals, to protect us from having fraud, to protect us from really like, and then the inventory being small, and builders not going crazy and overbuilding again like they did back in 05, 06. Like, so what would you
what are your thoughts about like a crash? Do you think it's going to be centralized I mean, I've heard corporate debt's going to be, something that we got to watch out for. That's going to be a bubble that's going to pop. But as far as like just residential real estate, what are your thoughts on that, being that we've been so tight?
This is going to go into a second hour, you realize. I'll give you my very short synopsis on what I feel the crash was. And it really gets back to, if you go back to Econ 101 and entry-level college course, supply and demand.
Yeah.
Traditionally, in the mortgage space, housing, there's a relationship between housing prices and median income. And that relationship narrows and broadens based on a couple variables. One would be interest rates. So even at the median household income, if the interest rates get lower, you could support more house price with the same amount of household income. And if there's only so much real estate inventory out there, there could be a tendency, hey, we can buy a house, the rates are really low, and you get some more bidders out there, and supply and demand, there's more buyers than sellers, and it'll drive the price up.
Right.
Similarly, when rates increase, that gap narrows because this median household income can only support so much median house price.
Right.
So that relationship's been in there for all the times that we've tracked both of those numbers, but it goes through times where it's not quite parallel. My view of what the crash did was, because of some of the products, it removed the median household income cap.
Like ARMs or interest only or neg AMs, is that kind of thing?
That plus, I could tell you any number for my income.
So you took that thing out and threw it out the window.
So now my
household income.
So temporarily, for a couple years, my median household income is infinity.
Right. That just makes unlimited demand.
Unlimited buyers.
Yeah.
So now I have everyone in the world could buy a piece of property if they wished to.
Right.
And many of them wished to.
Right. Many of them did.
And when you have 100 buyers chasing a property instead of 10 buyers or one buyer, the price just skyrockets.
Right.
I can tell you that that's happened a couple different times. It's happened in the 70s, where the traditional spread between house price and median income got 20% worse than its historic norms. But then prices froze and median income rose to get back to that traditional, and then the market could legitimately go up again. So something has to give. The prices have to plateau until income approaches, or income has to go up so fast that it allows prices to go up again. In the 80s and late 90s, or early 90s, late 80s, it happened again, but it was like a upper 20s, and then the market had to close that gap. Well, during the height of the crisis, I sat in a meeting where we could demonstrate that traditional gap had stretched to 45%. The predictions were it was going to go to 55, where it actually did. But this is a year before the crash. We're seeing that bubble. And then historically, we knew that bubble would have to close 90% of that gap.
Right.
So, and at that point, the only way it could give, you just couldn't get household income to creep up that fast. So the only thing it had to give is you actually had to have value declines, which we hadn't had in the other bubbles. In the other bubbles, you had plateaus. In this, had to actually tank.
Interesting.
And so the market had to give back 50% of the 55% bubble had to be given back before the market could right itself. Getting back to your primary question, what could we have done differently to prevent that bubble? The thing that we did wrong, in my opinion, is that we continued to add fuel to the fire by doing those stated income or no income loans at extremely high LTVs.
Yep. Because the skin in the game wasn't there.
Yeah. If we could have dialed back the LTV as the bubble grew, people could still speculate on housing, but they'd have to do it with their own money.
Right.
And then the losses wouldn't have been lender losses.
There would have been less demand because less people had their own cash.
Yeah. And fewer people would have, it would have eliminated some of the speculators, the highly leveraged speculators. It would have been speculators that could afford to speculate with their own cash.
Right.
And then the losses that were taking place, again, going back to borrower repayment behavior, the losses that were taking place would have been losses out of people's cash, not out of lenders' vaults. So the thing we're doing differently today that encourages me is that even though we're doing creative products, we're doing them with people that have large equity stakes in the property.
Yep.
So even if they are speculating on a particular investment property or even a homeowner, they're speculating with their money. They're not speculating with money I have in the vault.
Right.
And
people would play a lot differently in Vegas if they had their own money versus someone else's money.
Yeah. That's a great point. If you get $10 of free play, you're like, woo.
They're like, hey, give me some money. I'll bet it on black or bet it on red. I'm like, no, I'll do it when I go to Vegas. You can bet your own money.
Yeah. So that's my short opinion of what made prices go crazy is you took the cap off of median income. And I still think you could have controlled it if you hadn't accommodated it with extremely high LTVs on that type of product.
Right. So you think we're going to be okay?
The skin in the game makes me feel like if people are going to take losses because of a price correction, it's going to be out of their equity, not out of their loan amount.
Interesting.
So
Yeah, that's good. So last question for you, Jerry. If you were to say, to hell with underwriting, I'm going to go back to being a mortgage broker, what would you do today to try to find these kind of borrowers? Like, how would you buy leads? Would you call up some referral sources? Like, how would you go about getting these type of loans?
I believe where the business may be going would be taking like an inbound marketing approach where you become a resource for people's questions. So long before they even think about buying a piece of real estate, they start to think about what does it even take to do that? And you create an area where people can navigate in and read, watch videos, the kind of things you're doing, self-educate, and then create a forum where as people get more and more educated and they realize, I think I'm ready based on these tools and the things I'm reading, and I probably could afford a house, and create a launching pad to where when they're ready to get pre-qualified, it's easier for them to do in maybe an automated way.
Maybe you'd build a website and create a little place for people to read, get educated, and then once they're ready, they can do a little application like online. So you'd kind of do some online marketing. I see that. Is there any type of other ways you'd get it? And that's creative, and I think that would work.
And I'm a big fan of the pre-approvals.
Yeah.
And so
for buyers, right?
Using a platform like that of finding out how much. The toughest thing about buying a piece of real estate is figuring out how to finance it.
Yeah.
If you reverse that process and figure out your financing first, then go find a real estate agent.
Right. Usually it goes the other way around, though. Most people are like, "Oh, let's go house hunting this weekend," but they don't do the hard work up front.
Yeah, and it's really not that hard work. We make it easy. A lot of companies make it easy for you to come in, bring a handful of credit documents in, and figure out. Based on today's rates and these programs, you could afford this.
Right.
And that number, then that's the time to go out and test the market and figure out what can I get for that kind of money? Is it something I want to put up with? What can I do to change those numbers?
That's cool.
And so to me, being an information base for people that want to get involved and getting them involved before they fall in love with the house, let's fall in love with your financing first,
right.
And then leverage that into, you'll know what part of the market to be looking in and know what you can have.
Awesome. Jerry, thanks so much. It's been very informative, and I appreciate you coming on.
My pleasure.
Thank you for listening to our podcast. If you guys are looking for more content like this, we have a FundLoans YouTube channel where we give away more tips, secrets, and origination ideas. You can also email us at info@fundloans.com. And if you've made it this far, I think it's safe to say you like our content. So please subscribe, share, and send us your scenarios. Let's fund loans together.